This video is an introduction to basic bookkeeping fundamentals. My name is Zach Pasquarello and I have had a bookkeeping business for the past 3 years. It enabled me to quit my full-time job and I love every second of it. The only intention I have for creating these videos is to teach you how to start and grow your bookkeeping business. If you want to schedule a consultation with me, you can use the link in the description below to schedule a one-on-one meeting with me. Okay, let's not waste any time. Let's jump right into it. In this video, I want to talk about the basics of bookkeeping. So starting a bookkeeping business is a 4-step process. The first step, you need to learn about bookkeeping in QuickBooks. The second step, you need to learn how to do marketing and sales. The third step, you need to develop A+ customer service. And the fourth step, you need to work really hard to be successful. So in this video, I'm going to focus on step number 1. Subscribe to my channel if you're thinking about starting a bookkeeping business because I put out videos every single day teaching you tips and tricks on how to start and grow your bookkeeping business. Okay, first let's talk what is bookkeeping. Bookkeeping is the practice of recording and tracking the financial transactions of a business. Okay, so what does that mean? Basically, anytime a business spends money or earns money, anytime a business has money coming into their account or money leaving their account, you need to record that transaction somehow. You need to identify what was that for. That money might have been used for several different things. So here are some basic bookkeeping concepts. First, we have assets, then liabilities, then equity, then revenue, then expenses. Assets are things that you own. Liabilities are things that you owe. Equity is money to and from the owner. Revenue is money coming in. And expenses is money going out. So for assets, think about your checking account, the cash that your business has. Think about a building that your business has purchased, or maybe a vehicle like a truck, or a piece of machinery if you have a manufacturing warehouse, or a piece of equipment. Maybe you are a general contractor and you have like a bulldozer, or maybe you have a forklift. And then for liabilities, think about things that you owe. Most common liabilities are credit cards, mortgages, and loans to banks and other people. So if you acquire an asset, typically you're going to take out a loan or a liability to buy that asset. And then equity. Money to and from the business owner. So if I start a business, I might put $10,000 of my own personal money into my business. So that money going into my business is equity in the form of owner's investment. Or maybe I have a business and I pay myself every single month in the form of an owner's draw. So that would reduce my equity every month because I'm paying myself, I'm taking money out of my business. So think about equity as money to and from the business owner. And then finally, revenue and expenses are probably the most intuitive. Revenue, somebody pays me $1,000 to do their bookkeeping. That's revenue, money coming in. I provide a service or I sell a good. And then expense, maybe I buy insurance for my business, or maybe I pay for utilities for my office building, or maybe I pay an independent contractor to work for my business, or maybe I buy supplies. Those are all expenses, money going out. Okay, so now let's talk about financial statements. There are 2 main financial statements that you're going to work with as a bookkeeper. You have your balance sheet and your income statement. Your balance sheet has all of your assets, your liabilities, and your equity. So for your balance sheet, remember that your assets always equal your liabilities plus your equity. So let me give you a real quick example. Let's say that I have a business and I put $10,000 into my business. So my equity goes up by $10,000 and my assets go up because now I have $10,000 in my checking account. So assets equal liabilities plus equity. Now, let's say I take out a loan for $10,000 to buy a truck for my business. So now my liabilities go up by $5,000 because I just took out a loan to buy a truck, and my assets go up because I just acquired a truck for $5,000. So now I have $10,000 in my checking account, $5,000 in the value of a truck, a $5,000 loan, and $10,000 in owner's investment. So I have $15,000 in assets and then $15,000 in liabilities and equity. That's a really basic explanation of what a balance sheet would look like. It's going to represent your assets, liabilities, and equity in real time. Now, your income statement is also referred to as a profit and loss statement most commonly. This very simply has all of your revenue and all of your expenses. Think about revenue, I just explained it, money coming into your business because you provide a service or sell a product, and then all of your expenses. So you make $100,000, you spend $50,000 throughout the year on expenses, $100,000 minus $50,000, you have a net income, a net profit of $50,000 at the end of the year. This financial statement, this income statement, profit and loss statement is the most important whenever you're working with small business owners as a bookkeeper. This is what they care about the most. How much money am I spending? How much money am I making? What's left over? What's my profit? Okay, two other things that are very specific to bookkeepers is the chart of accounts. Chart of accounts is kind of a difficult concept to understand. Think about a filing cabinet. Inside that filing cabinet, you have individual files. So your filing cabinet is your chart of accounts, and then each file is a specific chart of account. And anytime you look at your financial statements, your balance sheet and your income statement, each line item on your balance sheet, each line item on your income statement is an individual chart of account. So your checking account is a particular chart of account. That truck that you bought is its own chart of account. Owner's investment, chart of account. Income, sales, services, that's a chart of account. Expenses, maybe insurance, office supplies and software, utilities, independent contractor, cost of goods sold, supplies and materials. Those are also a chart of account. So any line item on your balance sheet, any line item on your profit and loss statement, that's a chart of account. Anytime you categorize a transaction, you're going to choose which particular chart of account is associated with that specific transaction. Every transaction gets its own chart of account. Finally, we're going to talk about the general ledger. This is very specific to bookkeepers and accountants. Business owners don't really care about their general ledger. The CPA or the tax preparer might ask you as the bookkeeper to give them a general ledger at the end of the year, and it's very simply a list of every single transaction in any given period of time. So it's going to have all of the bank deposits, all of the bank withdrawals, all of the credit card transactions, all of the expenses, all of the income. It's a very long list, very detailed, individual, every single transaction. Okay, now let's talk about the daily tasks of a bookkeeper. What are you really going to be doing on a daily, weekly, and monthly basis? So it's a 3-step process. You're going to categorize transactions. I talked about this briefly before. You're going to use the chart of accounts to categorize transactions, and you really need to know 2 things. Who did you pay, or who gave you the money? Whether it's an expense, who did you pay, or if it's income, who gave you the money? And then what is the category? So if it's sales or services, that would be an income category. If it's an expense, then you're going to need to choose the appropriate expense account, the appropriate chart of accounts, the appropriate category for that expense. And then there's also things like assets and liabilities. The business that you're working on might have received a $10,000 loan. So you're going to see a $10,000 deposit into their account. That's not income, that is a loan or a liability. So it's important that you categorize transactions correctly. This is the most important step of bookkeeping, categorizing transactions, and this is what you're going to spend the majority of your time doing. Second thing you do is you reconcile your accounts on a monthly basis, and you're very simply going to take the bank statements or the credit card statements or the loan statements, and you're going to look at the ending balance at the end of the month, and then you're going to look at your QuickBooks or your bookkeeping software, and you're going to check, does the ending balance in my bookkeeping software match the ending balance on the bank statement or the credit card statement? And then finally, you're going to create financial statements. 2 most common financial statements, your profit and loss statement and your balance sheet. And as a bookkeeper, you're going to want to send the profit and loss statement to your customer, to your client, on a monthly basis. Try to do it the first 5 to 10 days of every single month. And if you're using bookkeeping software, you should be able to automatically generate these reports. You're not going to be using pen and paper to calculate these reports on a monthly basis. Your bookkeeping software should enable you to automatically generate these reports. Okay, last thing I'm going to talk about is who needs a bookkeeper. If you are starting a bookkeeping business, who is going to hire you? First of all, probably most common, business owners. So small businesses outsource their accounting because they probably don't have a large enough business to have a full-time employee do their bookkeeping and accounting. They definitely don't have a full accounting department, so they're going to outsource their bookkeeping for $200 to $500 per month. They're going to pay somebody, an independent contractor or a business owner like you, to do their bookkeeping for them. Business owners are very busy people. They wear multiple hats. They usually don't have time to do their own bookkeeping, or simply they don't want to do it, so they hire an independent bookkeeping firm to do it for them. Other people like CPAs, they focus on doing taxes and they focus on doing tax consulting and tax strategy. They don't really like doing bookkeeping. So a lot of CPA firms or a lot of independent CPAs will actually hire a bookkeeper to do all of their bookkeeping for them. And then finally, don't forget about independent contractors. Don't forget about those people that have a side hustle. Anybody who gets a 1099 technically should probably have some type of bookkeeping in place because they are able to write off expenses just like a business owner. So if you're a real estate agent or an independent contractor or a truck driver or a general contractor doing side jobs, you are able to write off your expenses. So you should be doing some type of bookkeeping or hire a bookkeeper to do it